Hey everybody, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're gonna go through Twitter like we normally do, see what people are sharing on social media. I think I might go through some comments as well on YouTube that I pasted on Word here. Wanted to answer some of those questions, and I can just answer it through a video. And it'll be related to commodities, financial topics, and/or wealth building. And let's dive in there. Let's see what's going on with the social media. At Finance Square Finance, if you want to find me on Twitter, and if you want to join our community, finding-value.com. We do have a discount going on there, LEAP for discount coupon code if you'd like to join. That's where I go into trainings, individual companies, individual sectors, and what I am doing in the portfolio. And I usually give a lot of people good entry points where things are bottoming out, and they generally bottom out. Takes about a couple weeks, months for a bottom, and then they start to usually come on up over time. So John Borshoff is doing it again, and the real uranium bull market has not even started yet. Deep Yellow 130x 2016 was a 5.8 million market cap, and now is trading at 740 million market cap. And this is what the chart looks like below. Pretty much, here, that cuts it off. Pretty much a massive move to the upside. Does this have a lot more to go? I mean, 740 million market cap is getting up there quite a bit, but they do have a lot of pounds in the ground. So, I mean, that's what you're going to have to figure out the valuation from. You know, what are you paying in pounds in the ground for the resource, and what is the future profitability of this company? And right now, the company is not making any money alongside a lot of the other uranium companies. So that's kind of the current situation that a lot of these uranium companies are facing. And I don't see a lot of these companies going into production within the next few years, outside of maybe just a small handful. So the majority of these will probably go into production, if they get into production, late 2020s, probably at the fastest time. We have another one here, J.R. Walensky saying fission uranium, low cost production, $10 cash cost, 14 all-in costs, huge profits with triple-digit uranium price, with even higher profits if it can share some of the infrastructure mill investment with next gen energy, as those are located somewhat similarly. But guys, this isn't going to go into production anytime soon. I know a lot of people say, you know, skate to where the puck is going. Well, you also have to be mindful that in a high interest rate environment and in a highly inflationary environment, it might be a lot more costly to build the infrastructure and the mills and all of that stuff in the future. So, you know, what does it look like in 2027, 2028, 2029 for building that stuff? Do you think the prices could go way up? Do you think it's going to be a lot more difficult to build it? Do you think the labor shortages are going to get any better? Or are they going to get a lot worse because the ones that go into production first are going to steal all the labor? They're going to take all the labor from these other smaller mining companies. I don't know, but I can tell you if these companies are going to go into production, I do see risk. I do see risk. It doesn't mean that I don't own these, but there is risk. That's what I'll say. Here's a couple of my posts in a row. Commodities to stock ratio. I also overlaid the last bull market fractal to this bull market. What do you think? This is the last bull market fractal going up. This is bottom to bottom, in my opinion. And then we've got the three-wave move. The super cycle is this entire move. The pullback that people are complaining about is the wave two pullback, in my opinion. There it is. You can see the whole fractal there. So you get a pull up, wave two fractal. Three, it goes sideways for a long time. That's considered to be wave four pullback. Usually you get a big long-term sideways move, and then you get a big move uh, as a peak eventually. And then looking at it zoomed in, you can kind of see how this overlay looks like of the last bull market to this bull market to see potentially how well it matches. And I think it matches pretty well the way this thing has moved. And I do think that we are close to a potential move higher, which could be driven by oil perhaps moving on up because oil is a big weighting in the CRB index. Here's gold miners are cheap to gold. When are we going to break the downtrend line so we can all just be happy? So here's the big downtrend line that I'm referring to. Need to break this line for happiness. We've been going sideways, building at least some sort of pressure here, holding the line, so to speak, for the gold and silver mining companies, but we could very well break to the downside depending on the market conditions. So again, we got to see this thing start to firm up and break that downtrend line. Here's construction spending. So construction still looks strong, perhaps a back test for inflation, is this one over here. So we can look at these. This is total construction spending, residential United States, just ripping it to the upside. We've got all employees construction. I don't see a pullback here. It looks pretty good as far as I can tell. Current move. We've got total construction spending in the United States in total $2.096 trillion. Massive move to the upside. Probably moving some of these jobs back to the United States would be my guess. And we're going to need to manufacture the infrastructure and the buildings and stuff to do that. And then we've got the United States inflation rate year over year. I drew this white line in there. That's kind of a downtrend line that we've broken, hit our head on some resistance, pulled back to a potential retest, back test there, and maybe we can start moving on up eventually. Scrolling down, PPI to CPI ratio. We were declining for a long time since 1940s, and to me, looks like it is putting in a double bottom, that booty bottom that I would talk about, where producer price index could outperform the consumer price index, which is inflationary. This kind of looks like a big bottom where we enter a very inflationary period. There's the 1940s, late 1940s coming all the way down. The 1970s inflationary period is this period here that comes up and stays elevated. Then we went into a large disinflationary period all the way down to the early 2000s. Early 2000s, we came up and we're putting in another double bottom here for 2020. We've come up, we've hit our head on a lot of resistance. We've pulled on back. And I think at some point we are going to come up a very large amount where the producer price index outperforms the consumer price index. That means that it's going to be very inflationary. And when the PPI outpaces the CPI, that is generally when oil goes ballistic. Oil and a lot of these commodities, fertilizers, stuff like that. I think that's coming, and I can't tell you what the trigger will be. Maybe we get a slowdown first. They drop rates, print a bunch of money, and then it just goes ballistic. I don't know the sequence of events necessarily, but I do think that this is going to go up, and or stay at least in a trading sideways channel at the short term. But I think eventually it will go up. It could be shortages in commodities that drive it too. M2 money supply and M2 time money, or it's M2 times money velocity as well. So this is just the M2 money supply. It looks like it's kicking back up on the right-hand side. It's like at least going sideways, maybe heading back higher. And then when you take the two, money supply times the velocity, I don't see any slowdowns here. It looks to me like this is accelerating. What that means is that we aren't going to see a slowdown necessarily in inflation because the slowdowns in inflation are generally these two, and this here is your gross domestic product. It's your M2 money supply times your velocity. We had a little bit of a pullback in 08, 09. We had a pullback in 2020, and I don't see one occurring here. So I don't think it's going to be like a huge deleveraging event. We're not going through a huge deleveraging event at this moment. I'll just say that. Why should the Fed cut at all given this chart? So this chart's a little bit against what some of the mainstream people think. Mainstream thinking that a recession is in the bag. But here it's saying financial conditions are becoming too easy to tame inflation. Now, that is to tame inflation. We can have a recession at the same time that we get inflation. Maybe, maybe everything is being hidden nominally. Nominally is that the price won't go down. So real GDP could contract, but the price in terms of nominal terms continues to go up because it's inflationary. It's hiding the weakness in the market. It could be the case. Here's nat gas. So nat gas, can we finish drawdown season with 2 trillion cubic feet? And look at, we are above that 5-year average, and we are way higher than where we need to be in terms of the historical 5-year average, which is in the middle of that big band. So yeah, we do have quite a bit of natural gas at this moment in inventory. Does that mean that we're in some huge glut? Maybe, maybe not. We'll see what the rest of the year um, has in store for it in terms of how cold it is, and we'll see what power burn does, because power burn has really been kicking up for electricity generation. Here's metals weekly price and performance. Palladium going up the most at 10.4% in a week. We've got tin going up 7.7, zinc going up, platinum up about 4%, copper up 3.7, silver up about 3.5. So those are the outperformers this past week. Guppy's saying we're doing 6 to 8% nominal GDP. That was this chart up here. GDP is this measurement here. We're going up like vertical here. That's our GDP. It's M2 money supply times velocity. But that is also delayed because I think the most recent data is October of 2023. Just to let you know. So we're running 6 to 8 nominal GDP. Fiscal's running at 7%, and inflation is accelerating. Meanwhile, Wall Street thinks we get multiple rate cuts, and he's laughing at that. They haven't been this offsides since March of 2020 when they panicked over germs. Sell bonds, buy the periodic table, which is basically commodities. And these are the Powlers here in terms of the May cut not going down again. Energy. Okay, so that is what I reported last time. There's a couple of things I want to answer here. We can kind of jump in here. So someone said, be careful what you wish for, as $200 plus oil will mean fuel, gas, petrol will be unaffordable for most, not to mention the cost increases for food, etc. One thing I will say, we already went through gasoline being the equivalent of $200 a barrel with crack spreads blowing out in 2021. So we already went through it. We already experienced what $200 oil feels like from a gasoline price point. Because since the crack spreads went up so much, we could see oil at $200 a barrel and have $4, $4.50 a gallon gas, at least in Colorado, and that would be $200 a barrel oil with regular crack spreads. If oil is the choke point, your crack spreads would probably be low if you're not constrained on capacity for refining, and your oil price could be very high. Last time we had lower oil prices, but our crack spreads were just insanely high. So it depends what your crack spreads are for refining gasoline and diesel and all that. If it's a refinery constraint, your crack spreads go big. If it's an oil constraint, your oil price will be big and your crack spreads will be small. So we already went through a $200 plus oil equivalent in terms of gasoline and petrol in 2021. This page is great, and so is Andy. The only thing I can't understand is why he doesn't understand or hasn't done the work in understanding Bitcoin. I would suspect it has to do with the natural resource bias he has. Those will do well, but he's leaving out the best investment we've ever seen. And it's a commodity, it's money, and more importantly, it's the most important human innovation in a long, long time. Okay, so here is my opinion on Bitcoin and why I don't like it. My question to everyone is, what is a fair value of Bitcoin? What is the fair value of Bitcoin? Put that in the comment section if you know what the price of Bitcoin should be. In natural resource sector, I can tell you what's cheap, I can tell you what's expensive, I can tell you companies, and I can buy the companies with good technical patterns and with good valuations. I can do only the technical analysis on Bitcoin, and I can give you absolutely no valuation opinion on it. And that's why I will not buy it. The way to lose a ton of money is to buy something where you have no idea what the value of it is. That is like the most important lesson. So, and here's another thing. All right. One of the best inventions when I was younger was a Sony Walkman. A Sony Walkman was something that was great. Now, my question is, during that time frame, and I think that was in the early mid 90s or something like that, if I can remember right, maybe even the late 80s, I can't remember. Um, Tell me something technology wise that was developed in the 80s and 90s that is better back then than today. That we didn't basically design out of the world already. I mean, outside of some like classic cars, I mean, the early 90s generated a bunch of awesome Japanese JDM cars, but I can't, I don't know of anything that's that great that is technology built in the 80s or early 90s that is still used today. So my question is, what makes you think that Bitcoin that was developed today is going to be used 10, 20 years from now? So if I can't value it and everything I know about technology basically gets, I don't know, designed out of it, designed out of this world, I just don't see the reason to be there. I think it's very dangerous in terms of the risk reward. So I don't play in that game, and I'm fine missing what other people think are opportunities. This guy says the commodity market is a disaster, guys, but what I see is gigantic returns that continue to pay me a bunch of money. I'm getting dividends that are over 20% of my original purchase price on a good chunk of my portfolio. Is that a disaster? I am also going up. I'm not going down. Commodities have been great. I think oil looks fantastic. And I think other ones like the pullback in natural gas. Now, natural gas, the equities haven't really pulled back all that much. I mean, yeah, they pulled back in some of them, but a lot of them, they've been quite resilient. So I don't think it's a disaster at all. I think it's actually a good value sector. And guys, here's something. I want to just say this. If all you do is chase value in the market and you avoid all of the speculative garbage, you will do absolutely fantastic in investing. It's really boring and it does take more time because some of the price movements don't go as fast. You're basically skipping on all of the last moves of bubble markets. And then you go and then you invest in the bottoms of these incredibly well valued companies that no one gives a crap about. That is the cycle. And when you finally exit that mindset of chasing price, you will see that you can win on a consistent basis with lower volatility by just sitting in these companies that go up slowly and pay you big dividends that are undervalued. Now, there's going to be a time where growth stocks will do incredibly well, but they're going up massively right now. But if you try to chase that, that's where all the trouble is at. The trouble is where the big price moves are going. When they're popping off, good luck. That's where you can get 40, 50, 60% declines very quickly. We're talking like in months. Some of these stocks are going to roll over. Now, what if I'm wrong? What if they go up another 6 months or even a year? Okay, I'm not in that market. I don't want to play that game. The risk reward is not in your favor. I don't play that game. So Bitcoin, it's off the table. I don't know how to value it. And all these other tech stocks, they're off the table. The risk reward is favored to the downside at some point here. Because what I love about this channel is that he actually tells you when things are going down. I was a uranium bull until today. Now I've changed my mind. I'm out of uranium until March. Okay, guys, I am not trading this short term. Um, the daily technical analysis was a favorite amongst a lot of people who like to watch uh, the market movements in the short term. I'm a long-term investor. I am not selling out of my uranium stocks at this time. I'm still holding on. I'm a long-term investor. I don't try to time the short-term market movements. Now, I try to time my buy points as best as I can, like everyone should. And I cost average in at very low points, and then I sit, and it's really, really boring. And a lot of people are probably going to sell if something doesn't go up after a few weeks. I am a lot more patient, and I look at it as a way to preserve my purchasing power. So if I got a company that's way down there and I can start cost averaging in, I'm going to buy it. And then maybe some 5, 6 years later, I'm up 10, 20, 30 times my money. And people will say, oh, that takes too long to make that amount of money. Okay, do your thing then. That's okay. I'll do mine. It sounds like a lot of sour grapes from people who missed the tech rally. It is possible for commodities and growth stocks to go up at the same time, especially if we're in a period similar to the early 2000s. Look at 2002 to 2007. That's where commodities and growth stocks went up at the same time. But that's also when the dollar went down. The dollar went down starting at 2002. And then that really provided a big move to the upside for um, for our commodities sectors. So yeah, that very well could be the case. And if we get rates to come back down, I think it will spur more real estate building. What because the affordability will go up for first-time home buyers and a lot of that stuff. Says yes, when gold and silver's up, Andy's always back in the miners camp. I've tried numerous times to tell Andy that oil went up 200 to 300% during 2000. Still, miners went up 5, 6, 700%. Miners will go up even if oil goes up. This has happened before, and it will happen again. In 2000, um, here I can pull that up because let's go look at that uh, here for a second. So let's go to gold to oil ratio, and um, this is the gold to oil ratio. And you said 2000, so let's go back to 2000. And in 2000, we could see that gold outperformed pretty big through here. So we had a big outperformance there, but for the most part, it was pretty stable at a ratio of about 15 all the way down to about 6. So it was just bouncing back and forth. Oil did very well during that period. I know the gold and silver mining companies, so we can do XAU divided by GC1, did very well in that beginning period from 2000 up to about 2002. That's the move that he's talking about. What I think is coming if we get a large inflationary move is that we're gonna break this downtrend here right through here, and we have a lot more valuation runway to potentially go up if this were to break. But I can also flip this around and look at crude oil divided by gold. And this is crude oil divided by gold. I still think that this is favoring a crude oil outperformance, where I think that we are squeezing up against gold, crude oil versus gold. Think of this as a flag pattern. We're basically flagging out, and I think this is a continuation pattern to the upside that will eventually outperform for crude oil. So I'm in the camp that crude oil is going to do very well, and that's where I would place, my money if I had a choice there. So it could be the case, but we got to see the downtrend line break. Related to platinum, check this out, Andy. It says the Environmental Protection Agency will require diesel engine makers to further reduce nitrogen oxide emissions by about 80% starting in 2027. This requirement is expected to lead truck manufacturers to double the treatment and filtering systems now applied to diesel engine exhaust, which industry analysts estimate will likely add about $30,000 to the cost of a new heavy duty tractor truck. Wow. This is such a mind blowing statement. The amount of PGMs we will need for this policies will be crazy. Well, I've got some investment ideas around that. That's a big deal if that goes the way that it is. And that's only a few years out, guys. I'm kind of new to this investing thing, but a bull market means things go up eventually. I'm just confused because my stocks keep going down. If that's the case, you need to get in some stocks that go up. You need help. Oil, I think, will go up here soon. Look at some potential oil areas. A lot of the times, what people do is they chase price performance. You want to chase what is down. Look for negative sentiment. Just like this one below, it says, Andy, you seem a bit delusional on oil. That was 10 days ago, and here we are breaking to the upside almost. That's when you want to buy. When people are calling you delusional, that's exactly when you want to be looking at potential investments. So if you need help, yeah, go ahead, sign up to the thing, use the word leap. Try it out for a month or two, see what you learn. And maybe I can help you out in terms of potential stock selection. Obviously, you make the ultimate decision and the ultimate call, but that's what we do. We go over stocks, we go over businesses. I tell you, hey, look, this looks really cheap. Not just from a price perspective, but what's the market cap or enterprise value to the free cash flow that the company has? Some of these companies, 2 times free cash flow, 2 times or 3 times or 4 times free cash flow, somewhere in that range. Some of the companies that a lot of these people are going into, they don't even have cash flow. So you're taking a risk, you're speculating. And a lot of times, it doesn't turn out the way you think it's supposed to turn out. So yeah, that happens. But that's where I'm going to end it, guys. Give me a thumb up for the content. Subscribe to the channel. Look, take a look at the website if you like. And that's what I've got for today. So we'll catch you later. This is Finding Value.